Hi, my name's Andrew Masters and I'm an analyst at FIBO Group, and in this video we'll talk about candlesticks and their kinds. We've already pointed out that it's possible to determine how the market behaves during a particular period with the help of candlesticks. We know where the market opened, what ceiling the price they set for the particular asset, what was the lowest price, as well as what level the market was closed. Thus, the candlesticks are also classified. They are divided into three large groups. Large candlesticks have a massive body. Spinning tops and paper umbrellas have a small body. And also the doji. This type of candlestick is notable for a small near zero body and completely goes without it. This happens when the opening price is equal to the closing price. Now let's talk about the influence of the shadows of the candlesticks, their function, and what conclusions we shall arrive when the particular type of candlestick appears. When we see the large candlestick, we logically understand that the closing price greatly differs from the opening price. It means that there is a strong movement in the market, and the market has the required powers to follow the selected direction. As for shadows, the smaller they are, the better. The shadows that are closer to the candlestick and closing are of prime importance. Lack of shadow indicates that there is no doubt. Spinning tops and paper umbrellas. There are many forms and modifications in this category. There is a small body and a shadow or shadows. We will talk about these variants of a price flow forming a little later when studying candlestick patterns. Doji. This type of Japanese candlestick indicates that there is confusion in the market, as the closing price is nearly equal or equal to the opening price. The market opened, moved up and down, and then returned to the initial point. In order to understand how exactly to analyse the candlesticks, it is required to know the 5 key rules of their analysis. Rule number 1. Size, colour and pattern of the candlestick should be evaluated only after the candlestick is closed. We cannot judge what the candlestick is now in front of us until it's closed, because the situation in the market can change in a matter of seconds. Rule number 2. Candlestick size should be subjectively assessed by the trader based on the current market volatility. On one asset and time frame, the 30 points candlestick will be a large one, and for another, it's required for the price to pass at least 50 points in order to gain value. Rule number 3. Reversal candlestick configuration are considered at the top or the bottom of the market. We've already mentioned that candlestick configuration holds only at the bottom or at the top of the market, as well as near the significant levels. Rule number 4. The older the time frame, the more reliable the signal of the candlestick pattern is. For example, candlesticks in 4-hour periods are strong and make more reliable signals than 1 hour. Rule number 5. Reversal candlestick patterns indicate the price reversal and do not indicate distance the price chart will cover. There are different market assessment tools, and each one pursues its own goal. For example, the candlesticks give evidence of the market's crucial points, whether the price continues the previous rate or will it reverse and go in the opposite direction. The graphical analysis indicates what distance the price will cover. We can see that the properties differ. In our next lesson, we'll study the kinds of candlestick patterns and we'll touch upon such notions as strong and weak candlestick configuration.